Hey good people, I trust you're well. Welcome to today's session as we continue our series on how to trade Forex. And today we're going to talk about margin call, how to avoid margin call, and of course, spread. What is spread and commission in the Forex market and maybe other financial markets. Let's go. What is margin? What is margin call and how to actually avoid it? Margin is simply a portion of your funds that your forex broker sets aside from your account balance to keep your trade open and to ensure that you can cover the potential loss of the trade. This portion is margin used, or rather locked up, margin locked up, and it's locked up for the duration of that specific trade. So let me explain. For example, I know that right now everyone knows about leverage, right? Everyone knows about leverage. So let's talk about leverage a bit. Let's talk about leverage. So if you had 1:400 leverage, right, and your account balance, that is your capital, was $1,000, that means you're buying power, what we call BP, you're buying power, which is calculated by multiplying your account balance by your leverage, which will give you 400,000, right? $400,000. And at this point, we understand that for every dollar you have, you can buy 1 unit in the market. So with $400,000, that means you can buy 400,000 units. And 400,000 units, that gives you 4 standard lots, right? 4 standard lots. So for example, let's say you have 1:400 leverage and your balance is $1,000, and you buy 1 standard lot in the market, right? That means your margin locked up for 1 standard lot will be 400 multiplied by $250. Reason because you'll only be needing $250 from your $1,000 to purchase 1 standard lot, right? 250 by 400, that is $100,000. $100,000 equates to 100,000 units, which gives you 1 standard lot. Are we together? Yes. So with $1,000 and 1:400 leverage, you get 1 standard lot in the market. So the margin used, or rather the margin locked up, will be $250. That is the amount your broker will be needing to lock up to ensure that you can actually cover the potential loss of that trade. So they lock up to $50 and you still have $750 that is free, which we call margin free, or rather free margin. Yeah, we call free margin because you can take other position using that money. Okay, perfect. Let's continue. Let's talk about margin call. Margin call is a notification which lets you know that you need to deposit more money in your trading account or close losing positions. This is in order to free up more margin, right? The reason why you're closing these positions is because at that point you don't have enough money to actually sustain your trades. So let's do some simple maths here. Okay, let's do some simple maths yet again. Perfect. So let's say for example, you have $1,000 in your account, right? And your leverage is 1:100 leverage, which means you have $100,000, right? So you have, let's say you take 1 standard lot in the market. Your margin used at that point will be $1,000, Your entire balance, will be locked up to sustain that trade. Now, after this happens, and let's say that trade goes against you, you lose that trade. Let's say you lose to $50 of that trade. That means your position now is no longer one standard lot. Rather, your broker will start closing positions. So your broker will close that position from one standard lot to 0.75. Why? Because you do not have enough money to continue holding one standard lot in the market. Let's say the trade continues going against you and you lose $500. That means your broker now will reduce that position from 0.75 to 0.5 lots. Okay? And the reason why this is being done is because now, once you lose money, that means your margin locked up reduces as well. So you had $1,000, lost to $50, went to $750. From $750, you lose another to $50, you have to 0.5 lots, which is $500. If you lose another to $50, now at that point, your broker sends you what you call a margin call. And this is a notification which lets you know that you need to deposit more money in your trading account or close losing positions in order to free up more margin. If your trade is losing and there isn't enough money in your account to keep the trade open, the broker will start closing your positions until there isn't any more money in your account. In crypto, your position gets liquidated. That is what he said. Basically, in Forex, at this point, you blow your account. Okay, I know you have heard maybe some of your friends mention that, oh, I blown my account, I had my account blown. That is what they actually mean. When you lose your entire capital. When you lose your entire capital, then that means you've blown your account. Right? You lost everything. Perfect. So, margin call is sent if your position has lost 80% of the margin. When using leverage, 80% loss is very easy to reach. But usually, this percentage varies from broker to broker. You find your broker sending you a margin call maybe when your position loses 50% of the margin. Some brokers will send a margin call when the position reaches 80%. Okay, so this will vary from broker to broker. So how do you avoid a margin call? 1. Ensure that your account has enough money to keep your trades open. Okay, ensure that your account has enough money to keep your trades open. If you have more money in your account, yeah, and you take a position and it's losing, you won't receive a margin call because you still have more money to cover that loss. Number 2, ensuring that you have a stop loss for your trades or for your trade. I cannot insist this more. Every single time you open a trade, have a stop loss. A stop loss ensures that you don't lose more than you are willing to lose. Yeah. Once the price gets to your stop loss price, then you are taken out of the market. Number 3, use a lower leverage. Okay, this way you won't be exposed to big losses. You see, the more leverage you have, the higher the leverage, the bigger the risk. The lower the leverage, the lower, or rather the smaller, the risk. Number 4, ensure you only use 1%, 2% of your capital per position, per trade. This falls down in risk management, and of course we'll be going through risk management later in this series. But for now, all I want you to understand is if you have a stop loss and you just use a small margin of your capital, then you'll still have enough money. Even if you lose a trade, you'll have enough money to take another trade and to take another trade and to take another trade. Okay, perfect. Let's talk about spread. Let's talk about spread. What is spread in Forex? What is spread in Forex? Spread is the difference, this by definition, spread is the difference between the ask price and the bid price. Spread is what makes it possible for the Forex brokers to make money. Spread is in form of pips. Alright? What happens is the broker will take a small amount of money for every trade you place in reference with the spread at that time. So basically spread is like a transaction fee. You see the way you send someone M-Pesa and you are charged a small fee. Yeah? You get it? That is what spread is. This is how brokers make money. They make money either from spread or from commission. If it's commission, you agree with your broker that for every standard lot I take in the market with your brokerage firm, you'll be charging me, let's say, $5 or $7, right? But with spread, it will be varying. It varies. Okay? This is what I mean by spread. This is how you look for spread at any point in the market. Okay? So right here, you see that spread is at 2.1 pips. You see, when I hover my cursor here, I can see that spread is at 2.1 pips. And actually, this is a lot. Yeah? Spread can go as lower as 0.3. Sometimes if you trade Euro USD, which is the most traded currency in the world, you can find spreads at 0.0. Yeah? You see? But right now, because I'm actually making this video at night, it's actually 2 a.m. in the morning, so that's why spread is a bit higher. And actually we just had what we call rollover. Rollover is when yesterday's trades are being moved or rather shifted to the following day. That is what we call rollover, and at that point there's less liquidity in the market. By liquidity I mean money, and I mean that there are not as many traders in the market as they are during major sessions. Okay, during major sessions, and by major sessions I mean London and New York. Okay, so for example, if you take a trade and spread at that point is at 1 pip, yeah, and you take a standard lot in the market, and we know that per pip with a standard lot you lose or you make $10. So at that point your broker will charge you $10 for just taking that trade, and this is instant. Okay, it's in form of a drawdown. A drawdown is the loss you'll be seeing immediately you open your trade. Once you open your position, you'll see a negative. Okay, we'll be taking trades together, so I'll show you what I mean by drawdown. Okay, later in the series. So once you see that drawdown, that does not mean you have lost your trade. That just means that your broker has charged you $10 for taking that position. And if that position goes in your favor, then you make money. Okay? And then at that point, once you're making money, that spread does not even matter. Okay? Now, spread is usually different for different pairs. You need to trade pairs with small or narrower spreads. So we usually talk about narrower or wider spreads. Okay? Narrower or wider spreads. So all major currency pairs have smaller or rather narrower spreads. That is Euro USD, GBP USD, USD JPY, AUD USD, and USD CHF. All these major currency pairs, they all have narrower spreads. Spread is like a trading fee. If you open one standard lot position and say spread is at 1 pip for that pair in that specific time, the broker will instantly cut $10 from the position. It will be in form of a drawdown and will be negative 10 instantly. That is exactly what I meant. That is exactly what I meant. So guys, I hope you enjoyed today's session. That is all I have for you. And if you haven't watched the previous topics, kindly just go on my YouTube at Optimal FX TME, which is TME stands for Trading Made Easy, or go to TikTok at Optimal FX Trading Made Easy, or rather Optimal FX TME. And you can see those topics, watch them, and if you have any questions, just send me a message. You can see my phone number there, you can call, you can text me on WhatsApp, and we can talk about it if you have any questions. So guys, I hope you enjoyed that session, and I wish you a very nice time. And because it's at night here, good night.